evening to all of you. Thank you for joining us today. My name is Siju Chua, and I'll be a moderator for the next 90 minutes discussion. I volunteer for the IAA Asia and Advisory Asia Subcommittee. Closer to home in Singapore, I also volunteer with the Singapore Actuary Society as the chair of the International Committee and a council member. This webinar is brought to you by the IAA Advice and Assistance Asia Subcommittee. Now first, let me present you a welcome message from Richard Gabrov, the chair of the IAA Advice and Assistance Committee.
Virtual seminar organised with the IAA Asian Subcommittee. I'm Richard Galbraith, and I'm the chair of the IAA Advice and Assistance Committee, and I've got the honour of introducing today's event. Usually, this would be held before the Asian Actuarial Conference, but due to the ongoing global pandemic, we've decided to move it online, which allows us to reach many more actuaries to share your ideas and help us share best practice and develop our skills. Going forward, we're planning to hold these virtual seminars several times a year, so stay tuned for the next invite. We did not see the pandemic as a reason to postpone the important work of regional development throughout Asia and wider, and at your request, we've introduced a virtual seminar. As many of you know from previous seminars, we have the overarching theme of the professional actuary in times of uncertainty, considering the implications of COVID-19 on our work. Our professionalism and our ethics are fundamentally to us as actuaries. These make us great actuaries. Today, we're going to discuss important ideas on how the pandemic has impacted our corporate culture, working practices, and how we can deal with these challenges and opportunities. It's forced us to fundamentally look at the way we work, which can challenge us to maintain our professionalism in really difficult times. We've got experts from all around Asia discussing their experience and ideas on how to manage this. So without further ado, I pass you over to our moderator today, Seiju Chua. I know that you're really going to enjoy the first of our virtual seminars. Thank you.
Okay. Thank you, Richard, for the opening message. Now, just echoing on what Richard has said, the size of the audience today really demonstrates the inclusion and the diversity that the IAA aims to achieve. And in this time of uncertainty, the issues of professionalism, the best practice becomes even more important on top of people's minds. Okay. Here is our plan for today, right? We will have a presentation for 30 minutes, followed by a panel discussions targeting around 45 minutes. This afternoon, I'm very glad to be joined by Mr. William Song, the Chief Risk Officer of MSIG Asia based in Singapore. Now, William has over 20 years of experience from different insurance markets across Asia Pacific, including South Korea, Australia, and many Southeast Asian countries. Outside work, William has a new hobby to cook perfect steak for his family. So I think we all found new hobbies, new interests in this COVID-19, at least for Williams. I think he doesn't need to worry that the restaurants continue to be closed over the lockdown period. For the panel discussions, we are very honored to be joined by Dr. Jules Griebels. Jules is a co-vice chair of the Asia Advisory and Assistance Subcommittee. And Jules has over 30 years of experience in financial services, including one of his previous roles working with the IAAS for 6 years. Also with us today is Carla Zuniga from the IAA Secretariat Office. Carla is based in Canada, and she has stayed out with us to make sure that this event is running as smoothly as possible. So thank you, Carla. I hope to make this session as interactive as possible. We will have the Q&A sessions right after William's presentation, and we'll continue to take your questions during the panel discussion. So please keep your questions coming in. You can use the Q&A function at the bottom of the screen to type in your questions for Jules and for William. Now, in case you are trying to speak or to turn on your video, right, let me inform you that these features has been disabled for this webinar setting. Instead, I encourage you to use a Q&A session, a Q&A button at the end of the screen to ask questions to William and to Jules. Now, without further ado, let me invite William to give his presentation on the professional actuaries in times of uncertainty. William, over to you, please.
Thank you, Siju.
Yep, we can see your screen coming through.
Excellent, thank you. Well, first of all, good morning, good afternoon, and good evening, depending on where you're from today. And I'd like to thank Siju and the committee for giving me this opportunity to go through a very interesting session about what's been happening around the world and also COVID-19 and from actually a professional standpoint. So for today, the topic itself is somewhat, may appear to be somewhat generic, the professional actuary in times of uncertainty. So for today, as you know, there may have been a lot of different sessions and discussions and papers around what the impact of COVID-19 and 2020 has been to the insurance industry. So rather than making it a bit repetitive, what you may have already seen and heard and read, what I wanted to today was take you through from the lens of a non-life risk manager working in Asia Pacific, what some of these key issues are and have been in 4 different parts. Today's session will go through roughly about 40 minutes. The first part, I will take you through basic background around what we've seen in the first 8 months of 2020 and also heavily affected by COVID-19. The part 2 is really around 2021 and beyond. What the world might look like and what are the factors that we need to consider for the future. And then close to where we are today, then we will take you through what some of the ideas that we need to consider from actuarial and also risks point of view. In part 4, I'll wrap up with what the key challenges are, also considering our importance on professionalism as an actuarial profession. So we'll go through those 4. There'll be a lot of interesting topics to cover. In the meantime, any questions, as CJ mentioned before, please send those questions away, and they'll be the substance for our panel discussion later in the second half. So I will jump straight to it. So first one, 2020 and COVID-19. Before 2020, if I think about some of the stress events, some of the scenarios that we considered in one form or another, there's always been a reference to a pandemic. Honestly, from where I've seen it, it's always been perceived, I've been guilty of recognizing pandemic as a theoretical event. It's something that we consider localized pandemic, or at very worst, localized within a country. But this concept of global pandemic has never been a real issue or something that we've actually could imagine at all. As of last night, I believe we've got close to 24 million infected and close to more than 800,000 deaths coming from COVID-19. So this global pandemic really moved away from theoretical stress shock to something that we all now live with at the moment. So this has been a major shock to not just insurance, but overall. Then moving on to the next topic on economic turmoil. As of now, depending on which reference we're looking at, IMF or different investment banks forecast, 2020 economic shock will be anywhere in excess of 3% contraction of the global economy. That was as at April and May. But some may argue that it could get worse than that, and certainly worse than what we experienced during global financial crisis after Lehman Brothers shock. Now we think about 2021, once again, that's the one where we've got a huge a crystal ball to be figure out what the world might look like. But some of the firms are predicting that there will be a recovery coming in. Fairly strong recovery, but there's a huge uncertainty around this. Then we move close to the insurance market. So in Asia and also the places, I guess this will be relevant to most of the countries that we've seen so far, there's been a very significant contraction of the insurance market, particularly on the non-life insurance. You've got people that are lost jobs, businesses have actually shut down, factories aren't running, and people aren't buying cars and traveling. So with all these muted economic and social activities, that's translated into the contraction of the insurance market. And we are certainly seeing that right now, and it doesn't look like it's actually improving at all from what we can see so far. The fourth topic, the investment shocks. First, during the first 2 or 3 months of 2020, we've seen this vicious correction in equity market around the world. It was the fastest drop in stock market in history, I believe, and certainly fast and deeper than what we saw during Lehman Brothers shock. So we've seen that in the first quarter, and a lot of the insurance companies who's published the results during the first quarter of 2020 have actually recognized some of these losses, asset impairments, the spreads, credit spreads widening. That shock's gone through. Then during the second quarter of 2020, we've seen some really healthy recoveries coming in. Actually, it's been a surprise to a lot of people, I guess, how quickly and how aggressively it actually recovered. And in some of the markets, the stock market is now higher than it was before COVID-19. And that translates to how is this a bubble and how bad is actually this bubble if it continues on. So you get a lot of uncertainty and questions around this economic shock at the same time. Then now moving even closer to us as in insurance, we've seen some really unusual claims experience, claims observations throughout the first 6 months of the year. Most of them can be explained, and the obvious ones are obviously all the big pandemic or infectious disease claims that we've seen coming through in non-life insurance. Then subsequent to that, we've seen a lot of the muted motor activities. Traffics have basically dropped depending on which countries you're looking at due to country lockdown, and that resulted in reductions in claim frequency. So there's some temporary favorable experience that a lot of the direct motor insurance have seen so far. Then, of course, travels have stopped. So travel insurance experiences have dropped, and then there are a lot of claims coming out of that. At the same time, a lot of the commercial aspects of it, the activities have dropped, the claims aren't coming at the same time. So a lot of unusual features that we've seen, but it's been so rapid and so aggressive that it will take some time to really figure out what the real impact might be from 2020 COVID-19 shock. Then further into looking at our financial statements, there's been a shock to capital and the way we manage capital. That will be a big question mark around that. A lot of insurance regulators have actually issued a guidance on the need to exercise prudence when we are managing capital and how we should manage the dividends going forward. And then that, of course, were led by some of the profit shock that we've seen, whether it's coming from insurance or from investment side. And then lastly, we've seen some very rapid downgrades in some of the reinsurance counterparties, particularly from those who were had heavy and relatively aggressive asset strategies. So with those reductions in asset, that led to a weakening of the balance sheet of some of these counterparties, and then rating agencies have recognized that and started to downgrade. So I know I'm more or less generalizing what's happened in 2020, but I guess those 7 points are one way to see what the impacts have been as a whole related back to the insurance industry. I will now move to the second part. Now, let's think about going forward. Actuarial profession is really around looking at the past data, forming our own opinions based on the factors that will drive some of the key matrices, and then looking at how the world will look like in 2021 and beyond. So first and foremost, the most important and the magical question is really around the recovery shape. In one form or another, the economy will revert back with the vaccines that will be coming out hopefully soon. The economies will revert back, jobs will be created, assets will be reverting back, and the insurance markets will grow again. But really, the question is really around how will the shape be? There are so many different theories around it. There's a V shape, there's a U shape, elongated L shape. So depending on who you ask, the economic recovery becomes a really big question as to how we should be prepared for 2021 from an insurance company's perspective. Then it really comes down to a financial forecast. I've actually deliberately sequenced those two sub-bullet points in that order because I think that's how actuaries should really think about the company's financial strength. When it comes to that financial forecast, whilst we may not always pay attention to the details of the balance sheet, but it is important to understand what will our balance sheet look like for the future and how robust is it before we consider the profit forecast. There are, of course, important needs to generate for insurance companies to generate profit on a regular basis to service our shareholders to make sure it's financially viable. But the most important one during this unusual period is really around the strength of the balance sheet and its ability to withstand robustness stresses. And that points down to the anticipating additional stresses. So when it comes to the future, whether it's we're going through a pandemic and economic shock, and that's probably completely unrelated to the weather events. So just because we're going through this shock right now, it doesn't mean the Mother Nature will put a pause on the global climate change, the bushfires, the hailstorms and floods and rainfalls, typhoons. Those things can still happen. But sometimes we subconsciously try to ignore these stresses whilst these stresses are happening. So it's quite important to dissociate ourselves looking ahead. There could be additional stresses that we need to be able to anticipate to make sure that our balance sheet projections are adequate and able to withstand these stresses. Then moving on to the fourth point, changing market conditions. So this is really my personal view, really. Last 5-6 years, I believe in non-life insurance, we've been talking about the hardening of the reinsurance market that will drive the softness of the market that we're currently going through for the rates to go up. And we've been talking about for the last 5 years, but it's been dragging on a bit because of the additional capital is being pumped into the reinsurance market, particularly from alternative capital sources. So that's been the case so far. But if you think about all the losses that the reinsurers have actually suffered, the reducing return on equity for reinsurance market, and also depleting the reserving adequacy of these big multinational companies, seems to be a general and a consensus around the reinsurance market really beginning to harden this year. That is soon to be tested. So that changing market condition will drive introduce additional difficulties when it comes to financial projections and profit forecast. But what I think makes it exceptionally more difficult next year is really around a possible deviation away from the reinsurance market and the soft market. With the market contraction that we are seeing at the moment in the insurance industry, we've got issues with the growth, obviously, but lot of the insurance industry, particularly in those where you've got a lot of insurance companies fighting for market share, this hunger for growth may not disappear because the market is contracted, and only way to resolve the scale issues by growing. So possibly that these market conditions will actually start to deviate next year and create additional stresses in 2021 going forward, something we need to incorporate. Then the fifth point, the heightened credit risk. This is picking up from what we've seen in the first 8 months of the year already, that we've begun to observe some of the reinsurance counterparties actually suffering a financial strength, the weakening of the financial balance sheet. I'm really generalizing here, but at the same time, there are companies who've actually recovered as a result of the investment markets recovering. But nevertheless, it will take some time for the weaker counterparties to actually see the real effect of that going forward. So there's certainly a heightened credit risks on the reinsurance side. And lastly, the reserving strength. So I don't think any companies are actually separating the importance of the reserving strength here, but a lot of the reserves that have been built up over the past, if you look at a lot of the reports that have been published, have been getting weaker. So that reserving strength will also become a big question mark for the market for 2021 and the future. So I guess these 6 points are key items that I'll try to think about when I try to consider what the company or the market will look like over the next 12, 18 months. Okay, then I'll move on to the next section. Then let's talk about us, actuarial profession and also risk profession. I'm kind of repeating myself here, but the balance sheet strength is by far the most important aspect when I sequence what the important factors to consider from top to bottom in terms of priority. We are not really here to arbitrage, take advantage of the profit opportunities over 12-month horizon. We're really here to ensuring that providing right technical advice that will protect the strength of the balance sheet. So insurance companies will still be here in next 20, 30, 50 years' time. A lot of the reasons why these companies tend to fail, a lot of the failures that we've seen is actually too much focus on possibly short-term performance metrics. But we always have to have a view on what is the importance in terms of maintaining the sustainability of the insurance company. To me, it really comes to the balance sheet. I guess for obvious reason, the consequences of insurance companies becoming insolvent, it's not just a retail shop closing down. It's actually, there'll be social consequences. There'll be people who can't get their claims paid out. Some people's life will be ruined. Companies' continuance will be ruined. So there's such an important social responsibility for all the insurance companies, and that part of that is really contributed by actuarial professional advice to make sure the balance sheet is strong, and also leads to how we should manage the dividends. Second one, stress tests. So one of the guidance that I've read from the regulators is that there's importance to focus on not just a single stress, but multiple stresses. And this is such an important point from risk management and actuarial standpoint, where the point that I mentioned before, just because there's a pandemic and economic shock right now, it doesn't mean that there could not be a large loss or a cat event. So all of those shocks can still happen. We need to make sure we do our proper due diligence to make sure these stresses are tested properly and to make sure the companies are actually able to withstand these stresses in addition to what we're going through right now. Point 3, reserving. There was a paper that was published by a rating agency, AM Best, more than 10, 15 years ago. This is a US-based survey. What they've done is that conducted a survey and research on reasons for non-life insurance companies becoming insolvent. And number one reason is really reserving, inadequate reserving and pricing. And I can't highlight the importance of this topic. That's basically a bread and butter of actuarial. Tricky part for us is really around what should be our assumptions going forward. We need a view on loss ratios, the pattern of claims being paid, being reported, backlogs coming out. So a lot of difficulties around the reserving aspect of that. So it's really an important time for us to look at actual experience that we've seen to date, and then forming our subjective view based on all the information that are available to forecast what our projections might be like. It's easier to say than doing it, but we cannot simply rely on past pattern to be able to project the future, because there's been so many changes that we've seen so far. Fourth point, product pricing. So a lot of things were happening now. As I mentioned, the scale of the insurance premium start to contract. So typical scenario is that business volume is shrinking, but expenses may not be shrinking as much. At the same time, the reinsurance prices might change. The loss experience might change, all influenced by different levels of pricing and reinsurance, and also changes in discount rate. So there are a lot of moving parts there. So it's quite important to put those all together and then think about how should we price this new product, considering all the changes and coming up with a clear view on whether the rate should be higher or lower. Next point, reinsurance strategy. So a lot of moving parts on reinsurance. As I mentioned, the rates are hardening. Capital, depending on a company, capital could be on a thin or could be quite conservative, but it always comes down to, from an actuarial risk point of view, the risk versus the reward. This point is probably not particularly unique to this issue that are happening with COVID-19, but it comes down to, is it really worth keeping this risk in my balance sheet or ceding out to counterparty, but at what cost? So this will always be a question, but particularly an issue now with such a dynamic reinsurance market. Next one, asset allocation. So there's always a debate about the tactical allocation versus the long-term strategic allocation. In my personal opinion, we are not best trained to comment and advise on tactical allocation. I mean, if we could come up with a tactical view on an asset over the next 12-month horizon, we probably wouldn't be working for an insurance company. We'd be setting up on hedge funds and then trying to create value out of that. But our real value is connecting the dots between capital, reserving, and also insurance-related reinsurance and pricing, and then thinking about what is the most sustainable investment asset allocation that will protect the value of the company whilst generating sufficient returns for shareholders. So that long-term view is quite important, but admittedly, we do get sucked into some of the potential values that could be generated by focusing on tactical aspects of asset allocation. Last one. This one probably doesn't belong directly to actuarial, but more relevant to risk. So a lot of the issues have emerged as a result of COVID-19, especially with working from home. During the country lockdown, a lot of the most of us in Singapore have been working from home. That introduced a lot of different operational risks, info security, cyber, our operational risks. A lot of things have actually emerged. So it was quite an important time for us to really, from a risk perspective, test the robustness of the business continuity plan and adjusting them and identifying gaps to make sure that they're continuously improved. Because so far, the business continuity plan haven't really been tested to this far in this sort of scale. So the operational risk, whilst it may not be something that we always deal with from an actuarial standpoint, became a particularly important topic from a risk point of view. And the last one, the key challenges. So these, I've got 6 topics here to wrap up on part 4. For me, the most difficult part about dealing with such a dynamic and stressful environment is really coming up with a view on what the problems are. So I deal with people who in my company on investment side, reinsurance, underwriters, CEOs, board of directors, and they all have different problems, but sometimes it tends to be quite high level and generic. So the important one is really around quite a famous algorithm, Richard Feynman, a very famous physicist. He has a beautiful algorithm to deal with a situation where you've got very ambiguous problems that you're trying to solve. So 3 steps. Number 1, write down the problem. Step 2, think really, really hard. And step 3, write down the solution. It sounds so simple to actually execute it, but when you have a conversation with somebody that has a problem regarding COVID-19, and it may not be so clear, but going through the 3-step process, it forces you into very good discipline of articulating what the issues are. So that, I think, always becomes a good solution to dealing with a situation where we don't really know what problem we're trying to solve. Okay. Then the second one is fundamental. So as an actuary, we've been trained, we've been really well trained to deal with getting the right data, validating them, analyzing, setting assumptions, putting models around it, and then coming up with a conclusion results at the end. But because we've been bombarded with so many complicated random questions with random noises, it's sometimes difficult to stick to your fundamentals. So the one way to deal with this challenge, I think, is really to stay faithful to our training. We have been trained for situations such as this, but don't neglect the data, don't neglect the importance of setting conclusions, and stay faithful to our ability to build models and then making a good conclusion out of it. Number three, continuing off the second point, is a conclusion. Including myself, some of the actuaries are actually certainly guilty of flexing our muscles and analyzing our data and then coming up with lots of different views, but at the end doesn't have a conclusion. So every single report, every single analysis, if you want this to create value or lead into some sort of a decision, it must have an ending. And it goes back to Feynman's algorithm. Try to write down the conclusion. What is your recommendation and what do you want somebody else to do based on your advice? So having that conclusion ending is absolutely critical. Otherwise, you have an interesting report that somebody else will read and say, thank you very much, and you get filed away. So you want that the final conclusion and ending so that it leads somewhere. Number four, challenges. I really struggled with the idea of uncertainty as a young actuary a while ago. There are so many factors, so many things that could be wrong. I wasn't comfortable with generalizing, and I wasn't so comfortable with what could go wrong. But after a while, we begin to realize that every model is wrong, including all the world's most renowned scientists coming from US who's dealing with COVID-19. They all recognize that all models are wrong. It's the best technical reference point, but it may not be right. But once we come to terms with that, we should be more confident to say that this is a technical reference point and these are the disclaimers. What can go wrong? But this is my best advice. We shouldn't be so afraid to get things wrong. I mean, best estimate by definition means that generally half the time will be higher, half the time will be lower. But it's okay to be wrong. And if we have a clean communication with the stakeholders, most of the reasonable stakeholders will understand that. Then ultimately, communication. Next point. It's important that when we go through a lot of exercise and analytical process, it's quite easy for us to bombard the final conclusion with dozens of points. But we have to learn to prioritize what are the three most important points that we want to include. And I have this rule called 3 points rule. If I've got no other choice but to come up with 3 conclusions that I want to convey to a stakeholder in a little post-it note, just 3 points, what would those 3 points be? And this is really the hard bit. I believe it was Winston Churchill, when he wrote a letter to one of his generals, he actually said, I didn't have a time to write a short letter, hence I've got a very long letter for you, and I do apologize for that. It's much harder to write 3 clean bullet points for someone to take actions on, as opposed to writing a 3-page paper with dozens of action points. That's the easy bit. So important part is when you communicate, you could be clear about it, but important my substance must be clean and very, very easy to understand it. And then force yourself to write those 3-point rules. It's hard to do it. That's when you've gone through all the analysis, the important factor is to sort of put a pause on it, go for a walk, drink some nice coffee, and then write those 3 points down by detaching yourself away from the nitty-gritty numbers first. And the last one is don't pretend. A lot of things that are happening in the world now. We've got, as I mentioned, the economic crisis, pandemic, vaccines, the investments, reinsurance, terms and conditions of policies. it's not possible for an actuary to be able to understand all of that and come up with a clean conclusion that that stakeholders can act on. It's okay to say that, well, I'm not the best person to comment on how infectious disease clause will impact our pricing and reserving and reinsurance, but this is the best information I could gather from the discussion that I've had. So I think when I started as a consultant, I remember there's always a section on reliances, and I couldn't quite understand, well, why is the reliances so comprehensive? But now I understand that there are some parts of our work that we must rely on people with in-depth knowledge on more specialist topics. So we don't have to pretend that we know everything. It's okay for us to recognize what we don't know, and then collectively putting it together into a more holistic assessment and finally the advice. So in 30 minutes, I've gone through pretty quickly on some of the topics so far. So that's the final part of the key challenges as a professional actuary. So this is the first part of today's session. Well, thank you for your listening to me in the first 30 minutes. And I believe now we're going to move on to the panel discussion. Thank you.
Thank you, William. Thank you for the presentation. It's interesting you mentioned about these 3 points rules on the communications. I remember just recently I was asked to give a summary, keeping it to the 5 points, and I was not able to. I actually went on to 7 points, and this person said, hey, I asked for 5 points. So it looks like I need to practice on this harder on getting it down to 3 points. Yeah, William, we have a few questions coming through on the Q&A. So
yes,
why not we take a few questions now before we move on to the panel discussions. Yeah, I think we can target, let's say, take 2 or 3 questions, see how it goes. So I'd like to just kick off with the first question, William, and this is really related to the context that COVID-19 and the remote working from home changing our work practices. So do you think that the challenges that you mentioned just now on communication, drawing a conclusion, these things are getting harder with this work from home setup? What are the common pitfalls or potential pitfalls that you have seen?
That's a very good question. So with challenges that we've seen that I've explained here, one of the point that may not be so obvious is that a lot of those points are dependent on my interaction with my peers. But with working from home, my single source of information is my 11-inch screen laptop. There's no other way for me to be able to gather information from my colleagues other than setting up a meeting, having a meeting agenda. So that, I think, eliminates, whilst we could understand the importance of the water cooler chit chat, there are a lot of information that I could gather from traveling to my our colleagues in Bangkok or Kuala Lumpur, or having a quick coffee chat with my colleagues. There are a lot of information getting back and forth. So I think the key challenge is that a lot of the issues that we're facing, I feel like I am missing out on some very important information that I would have gotten pre-COVID-19. I'm only relying on my Outlook calendar, the meetings that I have with specific agenda. So I think that really concerns me, actually, because there's no more chit chat that a lot of critical information that I know were picked up from those discussions with my team members. So how are you doing? Oh, by the way, I heard about this is happening in this country. What's your view on that? I can't have those conversations anymore, at least on a regular basis. So I think that makes it even more challenging under this current environment.
Mm-hmm. Okay. William, I'm going to move on to a slightly different perspective about regulators here. So I have 2 questions. I'm probably trying to kind of combine them into one big question here. Now, the question is, what could be the challenges for the insurance regulators? And then we have another participant that asks, in terms of, you talk about the solvency risk, right? And how insurers, the insolvency has a bigger social impact. If you look at in Singapore, are there any actions taken by the regulators in Singapore to mitigate the risk? So first is the big question on the challenges on the regulators, and then zoom into, in Singapore, what are the regulators doing in mitigating the insolvency risk?
I see. That's also quite a difficult question to answer, actually. So if I sort of think aloud what the key challenges for the regulators might be, I guess I could flip the question around a little bit. So maybe I could ask myself, what are the comforting factors from a regulator's point of view, given what's happening? So if I look back last 10, 15 years, regulators have introduced a lot of framework to deal with situations just like this. We've got the RBC framework to deal with asset shocks, reserving, pricing, NatCat, operational. There are capital measures and controls to deal with that. Then we've got the risk management framework. Then we've got the governance framework. And then the fit and proper framework that have already been introduced in most of the developed insurance companies. So from the other side of this question, if I was a regulator, I would look back all the work that's been done so far and say, well, we've worked so hard for the last 10, 15 years to introduce all these control measures to make sure we can deal and survive the situation. So that's actually a comforting factor. But the other aspect of the answer to this original question is, what are the key challenges and what would keep me up awake if I was a regulator? It actually comes down to people. So the only way a fit and proper would work with non-executive directors, the actuaries and CRO is that you are really placing the faith on individual key members of a company doing the right thing. Long-term view, sustainability, not arbitraging the short-term profit. So that part is really the, I guess, difficult one to measure. Hence, things can go wrong. If you look at a lot of insolvencies that we've seen in the past, they have gone wrong not because there was a problem with the regulations, but really around some of the failures in some of the people in a very responsible position. So I guess I will go back to challenges really how would individuals with authority and power behave in such a tricky situation, given that you've got fairly robust rules that are already in place. I mean, you can never have a situation where framework or solvency regime or fit and proper would be perfect. You can't control that. But it always comes down to individuals. So that's the part that I think will be quite worried, I guess.
Thank you, William. I keep nodding here. It's really because I'm fully in agreement with you. I think it's not regulators has a role to play, but as individuals, professional actuaries, right? At all times is also you spoke about the fit and proper. You spoke about the short term and long term, and I think every individual, every actuaries have a role to play, keeping the professionalism. Yeah. I am getting some more questions, William, coming through. Excellent. More sort of the managing the stakeholders. I think those questions we can kind of save it for our panel discussions together with Jules. We can also draw into Jules' opinions on those things. Why not we move on to a panel discussion? Before that, let me just quickly share my screen. And that will just recap, right? Give a recap of how we are taking the questions, right? So let me go on to the next slide, please. Yeah. So just a reminder, thanks for the participants who are sending their questions. We are taking more questions right now. So please do use the Q&A functions at the bottom of the screen to send your questions. Now to kick off these panel discussions, Jules, can I check that you, yep, there's Jules there. So perhaps I will just start with a questions maybe, in view that actually in out of our almost 300 participants today here, we have many people from emerging, developing countries from the actuarial perspective, yeah, actually developing countries like Nepal, Myanmar, Vietnam. Just thinking about these new actuaries, right? So who can the new actuaries or the junior actuaries turn to, right, in terms of questions regarding actuarial judgment? Do you think the professional code of conduct is enough? Okay, so for that, maybe Jules, if I can turn to you first to get your opinions, please.
Yeah, I think the first thing to say is that this is tough stuff. There aren't well-defined formulas and rules that you can go and apply. You can't just turn to page 74 and pick up rule 17. It's not about rules. So it's difficult, and we need to recognise that. I think you flagged the code of conduct in particular, and each actuarial organisation has one. They're generally pretty similar. Is it enough? I think the answer is no. But what code of conduct does is it gives you a framework to start working and thinking within, but it's not going to provide the answers for you. So in terms of getting answers to a question that's sort of posed in the context of a code of conduct, you're going to need to talk to other people. So you've got peers in your company, potentially, who you can talk to, actuarial or not. They don't have to be actuaries. They might be, of course, but it's not a requirement. And you've got people who are senior to you in the company. That may or may not work, depending upon the situation you're dealing with. But you need to have the open lines of communication, which you can use. Your second line of defense, if you like, is peers and senior people who are active in the business world. Right? And again, you may or may not use them, but you need the lines of communication, and you have to maintain confidentiality and so on. But usually it's a good exercise to take the challenge you've got and reduce it to its essence. Maybe you only allow yourself 3 or 5 key points about it, in which case you remove any issues that are side issues and potentially confidential ones. The last issue you normally have with codes of conduct is it's the classic analogy of the game shows. It's phone a friend, and what that really means is usually your association will have a sort of a hotline that will go to the president of the association or 1 or 2 very senior people who said they will provide guidance, not solutions, but guidance. So you need to know those things, because when you get into a difficult situation, do note that I said when, not if, you need to have your plan sort of set out, because it's not good practice to make the plan up as you go under pressure. So you need to sort of think about it beforehand. The last bit I would add to that is you need to start flagging this stuff early. So as you start seeing an issue might arise and it might not, you need to start thinking about it. You need to document it if it's going to get to be really sort of adversarial, and you need to be honest. So, and so in the end, the codes of conduct are great frameworks, but they depend on the people on both sides of the problem to run it, and you have to run it with integrity and professionalism. And that, as I said, this is tough stuff. It can be hard. Sometimes, in some cases, people lose jobs over these things, and that's never easy or fun. So recognise its difficulty and put in place some defences, noting you can't walk away from it.
Yeah, thank you, Jules. So I think you kind of emphasize a few good important points here. It's not always just not just professions, but look internally, look upwards to our senior, not necessarily to be an actuary. I was just wondering whether William have any things that you want to add to that, William?
Sure. All the points that Jules mentioned before, I agree absolutely that they're all true and accurate. Only point that I would like to add is that as junior actuary, sometimes we tend to underestimate our own capability because of the absence of confidence. So, but at the end, we're not trying to solve a rocket science. We're not trying to build a rocket here. It's a simple, as I mentioned before, if you stick to your fundamentals, data, analysis, results, conclusion, and then you come up with some sort of a view. But what I tend to find with actuaries, the junior actuaries that I deal with, is that because of the confidence isn't really there, you have this fallacy that I must rely on somebody to come up with a conclusion. So for anybody to learn and rely on something, I think it's important to have your own view first, and then rely on a senior actuary to basically say, well, here's my story. This is how I got there. This is the problem. And I think I had to rely on A, B, and C. What do you think? That really elevates your maturity as an actuary, and you're thinking a lot deeper. But if you immediately from the beginning start to think that, well, this looks really hard. I've never dealt with a pandemic before. Why don't I phone a friend? Then you're really foregoing that learning opportunities right from the start. So, but my only advice for junior actuaries and really starting up is really have a crack at it. I mean, actuaries are generally nice people. You have a crack at it, then have a view, and then use that for your discussion with somebody more senior. And that's when this juicy, interesting stuff will actually come along. So don't forego this opportunity for you to think on your own, because we've been trained to do that.
Yeah,
thanks,
if I
William.
could just add to that a little. I think William's absolutely right. You do need to have a go. You do need to document what you've done. It's very important that you come to a conclusion. The bit I would add to it is you have to be humble about that conclusion. When you discuss it with people, right, you have to be willing to change and listen. If you're not willing to change, then you're being actuarially arrogant. Whereas if you are willing to listen and change, you're being actuarially humble, and that will get you a long way. But that flexibility is important.
Okay. Thank you, Jules. Yeah. Think what I pick up from here is really having a view and going into a conversations, right? Having these two-way conversations. Yeah. Building on that, I just want to pick on the next question, kind of slightly related to this, and this is about really managing the stakeholders, managing the pressure. So this question goes like this. So how do you balance the pressure from management to make sure, for example, what William talked about earlier, the balance sheets, right? This short-term, long-term pressure. How do you balance the pressure from management to make sure that the balance sheet looks good in most scenarios, but you don't actually think the scenario, sometimes maybe you think the scenario is too light. Yeah.
Understand.
Would you like to start first, William? How about?
Sure, I can start with that one because I sometimes deal with situations such as this quite frequently. So I think maybe there's two ways you can approach it. The first one is an easier way, and second one is a harder way, but probably more conducive. So first one is building up a clear boundary between actuary and the management. So what I mean by that is that, well, this is my view, my technical view, and then responsibilities for you to manage your own expectation with the shareholders. So that works sometimes because it keeps the actuarial assessment very independent. Then it becomes a commercial decision for the shareholders, the management, to listen and then make the commercial decision. But that you've drawn a boundary there, and that this is not really my problem. I don't interfere with the commercial aspects of the. If you as management feel that this is not really light or not too high, then someone else to decide. So that's one way, the easier way, because you basically build yourself a little bubble around actuarial bubble. And then I don't interfere with inside this bubble. Outside, this is really my comfort zone. That's the first one. Second one is a much harder one. So sitting down with that person, the stakeholder, and say, why do you think that this scenario is light or high or too low or too aggressive? So that could be, as Drew mentioned before, being a good listener and removing this actual arrogance makes it so much easier to break down the boundary. And then it could be that I may have missed something. So I'm only privy to what I know. Someone who's running a company will be able to see what's happening outside, across the entire enterprise, across different functions. So I want to know what I don't know. So, but once you get into that, you're getting further and possibly further and further away from the actual comfort zone of differentiating between technical assessment and more commercial aspect of that. So second one tends to be the case where you either build a good relationship or you don't. So I guess you just have to exercise basic judgment to see what is right or not, the options you take. I think this is the part where it comes with experience, I think.
Yeah, thank you, William. Jules, before I get to you, I just want to build on what William have said, right? And also adding more context from another question that just came in, right? We talk about balancing the pressure from management here, and there's this question that a senior risk officer suffers from depression as a result of whistleblowing on operational risk issues, right? So how could an actuary safely navigate through this this kind of pressure, this kind of depression environment while calling out the risk issues? Yeah. So still building on the pressure questions, but I'm maybe also bringing in the emotional aspect of it. Yeah. I just invite if Jules is able to sort of make some comments on that, share your views on that. Yeah.
I think this is getting into very difficult territory because medical conditions and depression are a separate thing that lives with a person, every person, independent of their profession or what they're doing. If they are subject to bullying, independent of who they are or what they are, then you should have human resources opportunities within your company to get help. And if you haven't, you're in a very difficult place. So the place you would turn to would be peers, probably outside the company, potentially, again, in that sense, the president of your association. But, you know, this is difficult and deep stuff to do. So you, and also as an actuary, you know, if you have to call out issues, to a point you have to call them out. That's why you're a professional. It's not all fun. And I think I would make the point, coming on from that and going back to William's last point, which I agree with, by the way. I think it's very important for actuaries wearing their actuarial hats to be clear on who's making the decision. And a lot of times when we go through actuarial education, there's sort of a presumption the actuary's making the decision, you know, doing the numbers and making the decision. In practice, that's often not the case, and probably nor should be, because there may well be influences that come to bear on decision that come from outside the actuarial domain and the actuary's not aware of. So you need to be very clear on who's making the decision. You need to be very clear on when you're providing advice, if you like, William mentioned, the reliances, constraints that sit around it. And you need to be very clear on when you're putting information into a decision-making process that involves you and others, that you don't get trapped into telling them what to do. You say, here are the, from my perspective, here are the issues and here are the implications for you, Mr. or Mrs. Decision Maker, but, you know, it's not my call. And if it's not your call, don't try and make it. So I think that clarity around who's making the decision and what the decision-making process is, and it better not be an empty process where the number you put in your report is the answer, then you've got a real governance failure, is important. And the last bit goes back to the professional skills as opposed to the technical skills, which is you have to communicate to those decision makers the impact of the numbers you've computed in a way that is timely. That's the first bit. You can't be late. Secondly, it's got to be incisive. So, you know, here's the best estimate. Here are two options more if you want to know. But those options might be summarised as best estimates, you're okay. Worst estimate is you're bust. And best estimate is, you know, you make lots of profit, or something less dramatic. And you have to put it in their terms. It's in terms that they understand. You don't speak to them in their terms, then the message doesn't get across because you're right. And the answer for that is if the message doesn't get to the people who it needs to get to, you didn't do the work. The work's completely wasted if they don't get it. So this communication part and seeing how they work in their terms, the recipients, that's actually, in the end, that's just as important as doing the technical stuff.
Okay, thank you, Jules and William. Thanks for the. Indeed, it was as Jules said, difficult, right? Tricky questions. Yeah. From now, I'm going to move on to slightly different context. Jules and Williams. Let's take a few questions here, more around the looking ahead. Things about AI, things about the technical areas, right? So let me start with these first questions. With the advancement of AI that allows faster and more accurate predictions, okay, are we, the actuaries, at risk of being replaced entirely by machines? Right? I think these questions came out not just in this seminar, but we probably have came across these questions many times in the past, right? And follow up to that is, what are the core skills that actuaries should focus on to ensure that we remain relevant despite the rise of machines? Yeah. So William, can I start that with you? AI, sure. I look just nodding, getting excited about this question.
I actually really like this question. In my previous conferences, I think I've been asked this question a couple of times, and I'm just going to repeat the same answer that I gave that maybe last year. So when it comes to this idea of rise of machine and AI and all these predictive analytics, they're certainly valid and very important for different applications. But when we think about insurance industry, more close to here, I guess, if you think about in Southeast Asia, maybe exclude countries like India, because India and China, where population is certainly a lot higher than what we see here. Generally, countries in Southeast Asia, problem with us is not really the ability to predict premium rates for workers' compensation and motor next year. A company who's underpriced for their workers' compensation now, it's not because they didn't have the right predictive analytics to do it. It's because they chose to underprice because they want to grow. So whilst there are importance of predictive analytics and making it more fine-tuned, I'm not quite sure whether they will solve the problem of underpricing. So that's the first part of it. Second one is really around what will actually make all this cool stuff like AI and all these things really work, because you need to have the concept of big data ready. In Singapore, Malaysia, and Thailand, close to this part of the world, you just don't have enough data to be able to really make it work and the price at that level. At the same time, you've got all these non-direct channels, agents and brokers and so on. So there are a lot of practical considerations that makes it exceptionally difficult. When you compare this versus, say, Amazon, whether you buy a book or a kitchenware from Amazon, the way you buy is exactly the same. The transaction process, shipping, the logistic process aspect of it is exactly the same. But you've got this humongous volume of data that allows the data science to be able to predict that. But in Singapore, or this part of Asia, it's really scattered market. The data is simply not there for us to be able to predict it to the nth degree. And to me, it's about priority. Is it really the priority there, or when some companies may not even have an understanding of what will lead to underpricing and financial losses when you undercut the market? So I think there are more important issues there. So that's then the rise of the machine aspect of this question. I think there are certain technical aspects of AI that will be valuable, but actual skill set is not so much about our ability to predict based on technical skill set. It's really around looking at the portfolio, distilling key messages out of random noise, and then making the right, clear 3-point recommendation to stakeholders to make sure you're protecting the company's long-term sustainability. So that part can never be replaced by the AI. because that involves so much human elements and interactions and communications that cannot be replaced by I just cannot imagine that happening.
Thank you, William. So you touch on not just the skills, right? The preparing our actual skill sets, but also you talk about sometimes the also matching the core objective of the projects, right? Should AI be used, right? Now I'm going to turn over to Jules, and still building on these questions. On the AI, there was another question coming through about we use a lot of data as a result of AI from various sources, including individuals' data. And the question is about how do we take care of individuals' data privacy, keeping in mind all the laws around it. Yeah. This perhaps also is a quite common questions, quite common things being debated the last 2 years. I'm just wondering whether is there any views or experience from Jules that you would like to share?
Yeah, I'd like to make a couple of comments on the previous question as well, if I may, because in some ways it goes to the core of what is the actuarial profession. Let me just provide you with a little bit of context for this. It's a very small profession. Globally, there are probably 80,000 fully qualified actuaries now only. There are 15 million doctors, and that's not enough. There are 5 million accountants. You could argue with whether that's enough or not. And there are 5 to 10 million lawyers, and we all know what the answer to that one is. But the point is, we're a very small profession. We're not going to take over technical data analytics or technical AI. It's just not going to happen, because there are lots more technicians in data analytics and AI than there are in our entire profession, and they've only been growing for about 10 years. So we need to stop pretending that we can dominate these things. The question is, from the profession's point of view, and therefore I would suggest from individual actuaries' point of view as well, is what's our niche? And I think the niche that actuaries have, and it goes to the breadth of their training, is we're the bridge between the techies on one hand and the decision makers on the other. So our job is actually, from a philosophical point of view, is to manage the techies and interpret what they say into a language the decision makers can understand. To do that, we certainly have to understand enough about those techie fields to be able to interpret it and manage it. We don't have to do it, right? Because we're not going to as a profession. It's just not going to happen. So this bridging role is really important, and that plays out into the education space as well, because the important part about collecting all these great tools that we get when we get our education, I'm not saying they're not great at all. It's not the tool. It's how you use the tool. And they're fundamentally different things, right? You can know the theory about how the circular saw works, especially when you plug it in, right? And it spins a lot. That's a very different thing than using that tool to cut a piece of wood to length for sake of argument. So draw that distinction between the tools and the use of the tools, and I would suggest that our role as a profession is our use of the tools is to be the bridge between techies on one hand and the users of the information on the other. That's not to say everybody has to do everything. Some actuaries will be in one direction, some in the other, but this is a sort of on average for the profession as a marker to start placing yourself and differentiating yourself as well from elements. So you should be able to ask the question of why should I use an actuary to interpret results from data analytics as opposed to someone who's probably just as proficient doing the algorithms as I am. And the answer is I interpret. You also raised the point about, this is a global concern, much broader than the actuarial profession, about privacy in data analytics or in data collection, big data. I think that what's happening is there are, laws are starting to be put in place to give people some minimal level of protection. I mean, laws always give you a minimal level of protection in this context by their nature. And they also need to be able to potentially give people redress when those rules are abused, deliberately or not. But I think there's a strong reality here that, you know, we have a lot less privacy than we used to. And with the amount of data that's out there and the rate at which it's being collected with or without our permission, you know, it's a concern, but the reality is it's not going to stop. So when we come to dealing with stuff ourselves in our professional lives, we have two levels of concern on this. One is the legal regulatory minimum standard, the black letter law, if you like. And the second one is the ethical one. So, and that is the question of, even though I might be allowed to do this, I could do it, should I? And that's a corporate culture and it's a personal integrity and a corporate culture question, because there are lots of things we could do, which we probably all agree we shouldn't. So that's where you start stamping your mark as a professional and you sort of step above the exploiters, in effect. But it's a difficult and dangerous area, and it's not going to get any easier.
Thank you, Jules, for chipping in as well. I am thinking there's a couple of questions here around looking ahead. More looking at a question is asking, in this challenging time of pandemic COVID-19, can we assume that this is creating opportunities for new competitors in the insurance industry because of this changing of market conditions very rapidly? Yeah, I probably just open this up, whether Jules or William want to take this first. In your view, do you think this changing environment of COVID-19 is bringing up to new opportunities for new competitors and broader insurance markets? Yeah.
Sure. I can try to have a crack at this question. So with what's been happening for over the last 6 months or more, the world has been forced to go digital. So things that we imagined was never possible, working from home for 6+ months, now it's possible. Not traveling, also possible. So the whole world is basically turned upside down. So with that whole digitalized 2020 and beyond, I guess it's possibly easy to think that, yes, it's an opportunity for digital companies to emerge, and then digital insurance companies rather, to emerge and then start to gain bigger market share and then possibly change. But I don't know the right answer to it, but I guess there are some difficulties that we've seen already. We've already seen a lot of direct companies jumping in, even before COVID-19, where it hasn't been that successful depending on which country you're looking at, because it's quite difficult to get the scale, and the initial investments always tends to be quite high. So with that in mind, I don't know if people's behavior to purchase insurance would change from a traditional approach to digital, because insurance is one of those things where you may not interact with the insurer so frequently. You might see them once a year if you have a claim, once or twice a year. But I don't know whether the behavior will change that so significantly that it creates opportunities for direct insurance to gain bigger piece of the market share. So I'm a little bit skeptical about that a little bit. But having said that, I guess with existing digital insurers that have already had operations for a few years, maybe they may be able to see that, well, since I can't go out there and actually buy these insurance policies by talking to the agents and brokers and going through, maybe there might be an uptick. And then if it's permanent, then it will stay there. But I have some reservations as to whether it'll be so earth-shattering impact on the way we buy insurance going forward. But I could be wrong. It could be a very famous Kodak moment. But I don't quite know whether it'll be that significant for the way we buy insurance will be permanently displaced, creating opportunities for digital insurers.
Yeah. So that's an interesting one that is related to many people trying to form views on what is it going, the outlook, right? The shapes. relating back to what you said just now, is it a U shape, a V, or is it the W curve, right? On this, William, I want to just build up on this context of the forward looking. Digital insurers have came up with attractive propositions and growth opportunities due to the pandemic, right? So actuaries are being asked to design digital products, visualize digital risks, and so on. So how best actuaries can prepare themselves for this new world?
I'll have a crack at that, because I think the answer is that actuaries have lots of skills which they learn by practicing and so on. The way that you prepare, or one of the ways you prepare for new environments, is you look at the skills you've got and you take out what the transferable skills are and you take them forward and apply them in a new area. You don't know the answer, and nor does anybody else, but in general, if actuaries are involved and they're taking a positive, transferable skill approach, I'll back actuaries against a lot of people. So there isn't, for some of this stuff, there isn't an answer, but there is an attitude which is very powerful, and I'll give you an example by what I mean about taking out transferable skills to make it clear. You can market yourself as, I can do evaluation of whatever, right? That's not very transferable, and for most people it's not very interesting either. But if you market yourself as saying, I've got the transferable skills of being able to assess the data to an appropriate level to solve a problem, I can set best estimate assumptions, I know what the standard methods of getting an answer are, and I can do it for you. I haven't actually mentioned valuation at all. What I've said is I've got a set of skills which I can apply to a lot of problems. So my advice for actuaries in a changing world is, don't dive into the technical books. Sit back and reflect on what your core transferable skills are from a technical point of view, so judgment, equity, that kind of stuff, and sit back and think of what your core transferable skills are from the professional point of view. I'm a good explainer, or I'm not, or whatever. And those are what you take forward. And that arms you to deal with all sorts of things. And when you don't know, right, we were talking about actuarial arrogance beforehand. When you don't know, admit it to yourself and go and find out. Find an expert, right, and translate their skills. Actuaries are good at that.
And we have seen ourselves also transferring into like learning, like cooking skills, right, William? So we are fully flexible. Anything you like to, anything you like to add to that, William? On preparing ourselves for the changing world.
No, couldn't understand any better. I mean, it's just going back to my point about staying faithful to your fundamentals. So that's exactly what Julie is saying. So whether it's digital product, whether it's a stock standard motor product, or whatever it is, one thing that we can take away is really our fundamentals, or fundamental ways of looking at risks and data and bunch of stuff. So staying faithful to your fundamentals and not really being too afraid to look at new things, and also connecting with the real experts. I think that's really it. Really all the points that you mentioned before.
Okay, thank you, William. We have roughly 8 minutes to the closing time, and now I still want to take this one last question, Jules, and I think it's a very, very important one. We have asking, what is the IAA has in mind for future actual education and research, particularly in the Asian market? I think what we have talked about earlier, from managing the pressure, managing the communications, AI, right, changing world. If you keep this in mind, so this one last question is, what does the IAA have in mind? Things that you are maybe aware of for future actual education and research, with a focus in Asia.
Thank you for that. I think we need to understand what the IAA's role is and isn't in that sense. So the IAA is an umbrella organisation, and it sits over all the local, regional associations. From an introductory education point of view, I'll come back to that in a sec. the IAA has specified a minimum syllabus that it expects all the associations who deliver actuarial education to meet. Right? But that's all it's done. And like all things, when you put in place standards, it's the minimum standard by definition. It roughly comes to the associate level or a little bit more if you look at the SOA or the IFOA or the Australian Institute and so on. And I don't mean that as a criticism. I think that's actually quite a good thing, but it's technically oriented. It doesn't really address the professionalism side of the game at all. So that's one thing. So in terms of future education, I think the IAA would see its role as supporting its education delivering members to deliver better education, maybe more globally focused. Well, that's a personal perspective on it, and maybe, you know, making sure that it passes its minimum standards, right? and encouraging people to surpass them. But that will be it. In terms of research, the IAA has a number of sections, and individuals can join those, and those sections are really primarily where the research work, the facilitation of research work, I guess, between those individuals takes place. And I'm sure the IAA would love to have more meetings, virtual or real, probably virtual now, and more people volunteering to join those. The caveat I would add to that is that historically those sections who focus on research have had a heavy first world actuarial focus, I guess, if you see what I mean. They have not always been as inclusive of actuarial issues that are arising in developing countries, and they tend to think they've already seen the problem, which frankly isn't the case. But they aren't as inclusive and as broad-based as they could be. So, you know, the plea, I would make a plea for, you know, experienced people in particular, is just about leading the research, not only participating. There's a participating role for more junior actuaries as well, because it's a learning experience. But you know, some leadership from some senior actuaries, if they're interested in being involved in the IAA in some of these sections, and you would, you know, you'd go in and say, we've got this issue that we dealt with in, I don't know, Vietnam, just to pick a place at random, right? Here's the issue, here's how it came up, and here's how we dealt with it. And, you know, you're going to start finding fairly quickly that people in the developed countries are going to go, oh, but you leapfrogged 30 years of our development, to which the answer is, yeah, I did. Because we had you to learn from. So I would also, and in that sense, I would say the IA, it's a bit like an oyster. I think if people want to participate and take advantage of the opportunities there, open the oyster and extract the pearls out. But you need to go to it, I think, would be the right. But if someone wanted to set up, now just speculating, you know, an Asian subsection of AFIR, for sake of argument, one of the groups, you know, apart from going through all the mechanics and that sort of stuff, I suspect that could be done. So it's get on the front foot and take the opportunity.
Yeah, thank you, Jules. If I may add also, it is the demand and supply, right? While IAA is there as a supplier of these information organized seminars, it's also the demand, we need the kind of the topic of interest, we need the participations from the region, right? As for example, what we see today here. Yeah. That leads us very nicely onto our sort of the closing remark, and maybe Jules can also just share a few of the upcoming activities. Before that, I just like to invite, maybe I will start with William first. I just want to invite William to give like a last piece of advice, right? For our actuaries. Maybe you can think about the young actuaries here, how to navigate through this time of uncertainty.
Okay, so I would, my final piece of advice to close today's session is really around, okay, especially with uncertainty, this quote that I've read from Elon Musk. So Elon Musk is actually one of my people that I really respect, considering having seen what he's done with PayPal, Tesla, SpaceX, and all of those things. So one of his famous principles is really around distilling the noises into fundamental points. So when you look at the big pieces of machinery, what you want to do is, rather than learning how the machine works, what you want to do is you want to distill that into what the key factors are that moves the machine as it is. I think that sort of mentality still applies very much to us. When you think about what moves balance sheet, what moves our reserves, or what moves whatever problems we do doing it, rather than replicating the knowledge that we've learned, which we're quite good at because we've been spending 3, 4, 5 years going through exams, and we've been trained to digest information and then regurgitate in our exam periods. But my advice is, don't do that. What you want to do is get to the core part of this complex problem and then find out its core fundamental factors so that you can better understand uncertainties. So it's just the way we've been trained, the way we've been passing exams for 4 or 5 years is you don't want to regurgitate what you know, but you want to decompose it. Once you free yourself away from this, the exam mode, it makes it a lot easier to pick up new information. You don't really get afraid, because whether it's building a rocket or doing a reserving, if you decompose it into finer bits, it's easier for your brain to absorb that. So that's my final advice in dealing with time of uncertainty. And once again, thank you for the Institute and Siju and Jules and all the organizers for giving me this opportunity. So I've really enjoyed today's discussion.
Yeah, thank you, William. Now, Jules, over to you, please. Your last piece of advice and the closing remark.
Yeah, I think I'll say, I think what William is saying, but in slightly different terms. So I would say my single piece of advice for actuaries is work out what your transferable skills are and transfer them. Be humble, right? So we talked about making a call. You should make a call and be humble about it and talk about it. And the last thing I'd add is we're dealing with uncertainty. We won't get it right all the time. Right? We will make mistakes. So you need to accept that and learn from them. If you sit back and wait for the perfect set of data to apply the perfect algorithm to, you're not going to get anywhere. So you will make mistakes. It's not the making the mistake that counts, it's how you deal with it and how you set it up to do that. So I think those are probably the 3 things. They will mean you are a bridge between the techies and the decision makers as a consequence of doing that. So in terms of closing, I think we've had a great discussion and lots of new and interesting points are emerging, certainly in my mind from being part of it, and hopefully in some of the listeners' minds as well. If we've opened your eyes to 1 or 2 insights, then we're both pleased and we've done our job for this presentation. So that's fantastic. I want to thank William for his excellent presentation and setting the context and getting us going, and to Siju for managing and directing the session and the discussion. I mean, my wife says that dealing with actuaries is like herding cats, so Siju did pretty well on that. And I think the large number of attendees we've had and most of who have still stayed, and the quality of the presentation and discussion, it demonstrates the appetite and the need for more sessions of this nature. So there's an untapped demand there. I would encourage everybody who's on the call to think about not only taking the CPD, if you like, and nothing wrong with that, all right, taking the professional, but also where they might contribute as well, because we need givers and takers to make this work. And as a profession, we need to be aware of both the professional and the technical actuarial issues. I mean, to put it in a slightly different way, whichever is the weakest link, that's as far as we're going to get. And if your weak link breaks, you're not going anywhere. So it's not enough for us to just do the calculations. We have to bring their impacts and consequences to the attention of those who we provide our services to. That's where we add the value. On behalf of the IAA's Advice and Assistance Asia Subcommittee, which is a really long title, but anyway, thank you all very much for participating, and we look forward to the next time we do the next IAA Asian virtual seminar, which we plan to be something like 3 months' time. And in the meantime, your feedback and your suggestions, of course, are always welcome. So I think we've touched on this. We have a roadmap, if you like, going from some years ago now with the Asian Regional Development Meetings through to 2015, where we did the first Asian Regional Seminar, which focused on the professional actuary, through to today, where we're dealing with uncertainty. In the future virtual seminars at the moment will also stay focused on the professional aspects of what we do and how we do it. So, as I say, interest and welcome, and suggestions are also welcome. I think there's a couple more bits of advertising here, aren't there, Siju?
Yes.
So, if you're interested in the pandemic a little bit, or forced to be interested in it, think about attending one way or the other. I don't know whether this is a virtual conference or a in-person conference, or frankly, probably it's going to be both. Global pandemics beyond the new normal in next April, depending on how many planes are flying. And I think there's here the SAS is having their joint health conference with the IAA health section in Singapore in May next year. So talk to someone about travel budgets, or at least time off budgets if you're going to do it remotely, and participate and support. I mean, that's the other thing for these conferences. We need people to attend to support them. We need people to contribute to them always. And I think the last one is that one, the ICA, International Congress of Actuaries, in Sydney in Australia in April 2022. This is, I like to describe this as the Actuarial Olympics. It happens every 4th year. It's the single highest prestige event that happens on the actuarial calendar because it's truly global. No one else is. So please think about whether you can attend. Again, given how the world is emerging, this will probably be both in-person and virtual, because I think all conferences going forward will be. The extent we don't know. But yeah, talk to your managers about how you would benefit from being part of this, and potentially how you might benefit from submitting a paper to it. So, you know, with a bit of luck, I could look forward to seeing everybody in Sydney, if not beforehand.
Okay. Thank you, Jules. Now, I just want to again thank you again to William, Jules, and Carla staying up with us for the great discussions, and thank you the participants for your active questions. Now, we did not manage to answer all the questions, but what we will do is to put up a complete Q&A and make it available on the IA website along with this recording. Okay, we would like to hear from you how to improve this seminar in the future. So we will be sending you a separate link for a small survey. Hopefully you can also give us your feedback. And yeah, lastly, I certainly have enjoyed with a few takeaways here. Stay humble, 3 points of conclusions. I'll keep that in mind, and I hope you have learned as much as I have learned in the last 90 minutes. So thank you again for your participation, and we see you at the next seminar. Thank you.
Bye, everybody.
Bye-bye. Thank you all.
Cheers.